Hello and welcome. Today's discussion is brought to you by the experts at My Tax Accountant. We're diving into a massive shift in how HMRC sees the UK's growing army of freelancers. It's a story all about data, predictive technology, and the very real consequences of being flagged by a machine. So, are these new systems creating smarter tax collection, or are they digital traps?
Let's start with a slightly different question. What if HMRC knew almost everything about your financial life before you even filed your self-assessment? Imagine a system that sees your bank transfers, your online sales, your property records, and even your social media posts. It sounds a bit like science fiction, doesn't it? But this is the promise that's driving a huge technological revolution inside the UK's tax authority.
So how is this happening? Well, the goal from HMRC's perspective is to create a seamless tax system. The vision is to make tax collection as efficient as possible, closing what they call the tax gap, the difference between what's owed and what's actually collected. But to do that, they have to solve a very old problem.
And that problem is data silos. Historically, information was kept in separate, disconnected databases. Your bank had its data, online marketplaces like eBay or Vinted had theirs, and the land registry had its own. What HMRC has been building for years is a powerful system to break down these walls, allowing all that data to flow into one central place. This allows them to see a whole person financially, not just the bits you declare on a tax return.
And when that data is shared and connected, the potential from HMRC's point of view is huge. It's not just about finding major criminals. It's about ensuring fairness across the board and using technology to spot discrepancies that humans might miss. Let's see what this looks like in practice.
The key technology making this all possible is predictive analytics. It sounds complicated, but the idea is actually pretty straightforward. By combining billions of data points from all those different sources, powerful algorithms can identify patterns. They can then calculate a risk score for your tax return, predicting the likelihood of an error or underdeclared income. This score helps HMRC prioritize who gets audited. And this isn't just a theory. HMRC's Connect system is a real-world example of this in action. It's a massive data crunching machine that's been in development for over a decade. It improves its accuracy by constantly learning. For instance, it can cross-reference declared income with things like VAT returns, or even interest earned from savings accounts. It also specifically looks for mismatches, like someone declaring a low income but having a lifestyle that suggests otherwise. That's not all. Here's where most people go wrong.
And the numbers really show the power of this approach. Just in the 2025 to 2026 tax year, it's estimated that the Connect system and related data initiatives helped HMRC bring in billions of pounds in extra tax revenue that might otherwise have been lost. By linking data, it can uncover connections that were previously invisible, flagging cases for investigation with incredible accuracy.
Now, from HMRC's perspective, this is all about leveling the playing field. The official line is that these tools are designed to catch deliberate tax evaders and ensure that the vast majority of people who pay their taxes fairly aren't disadvantaged. It's framed as a way of creating a more just system for everyone, using technology to make sure compliance is high. So let's look at a quick example of how this might work. Picture a freelance graphic designer in London. They declare an income of £35,000, but the Connect system sees data from an online platform showing they received payments totaling £50,000. It also flags bank transactions that don't match up with their declared business expenses. The algorithm puts all this together, assigns a high-risk score, and boom, their file lands on an investigator's desk.
But for every pound of tax collected this way, there's a flip side. For the honest freelancer who's just made a mistake or whose finances are simply complex, this data-driven dream can quickly become a stressful, terrifying nightmare.
And this is where we see the real danger. It's what happens when you build a system focused on numbers and patterns without necessarily accounting for the complicated reality of people's lives. When technology is designed without empathy, the consequences for the individual can be huge.
Imagine getting that letter, a formal inquiry from HMRC. You don't know what you've done wrong, only that a machine has flagged you as suspicious. It's no longer a conversation, it feels like an accusation. The whole process can feel impersonal and threatening, and it puts the entire burden of proof on you to show you're innocent. People can easily fall into an automation trap. First, your profile is flagged by the algorithm. Then, an investigation is opened, often with a presumption of guilt. Next, you have to find and organize years of complex records, invoices, receipts, bank statements, to defend yourself. All of this can leave you in a state of serious financial and mental distress, with no clear way to just talk to someone and explain. Stay with me, the next point might surprise you. And this gets us to the heart of the issue, risk profiling. This is a system that flags you for investigation based on suspicious characteristics in your profile, not necessarily on concrete evidence of fraud. You're not being investigated for something you did, but for looking like someone who might do something. It's a system based on probability, not on proof.
HMRC's Connect system works just like this. It takes in billions of data points as its source. Its main action is to assign that hidden risk score to your tax return. And the result? If your score crosses a certain threshold, your file is automatically flagged for a human to review and a potential audit is launched. You're effectively under suspicion before a person has even looked at your case.
And here's the real danger. These algorithms are trained on historical data. If a certain group, say gig economy workers, has been investigated more in the past, the machine learns to see them as higher risk. Then investigators, trusting the machine, might focus their efforts there. Whatever they find is then fed back into the system, reinforcing the original bias. It can become a self-fulfilling prophecy, where certain types of self-employed people are targeted more and more over time.
So, who is most at risk in this new digital world? Well, it's a huge and growing portion of the workforce. The assumption that everyone's finances are neat and tidy is a dangerous one. It creates a whole class of people who are algorithmically vulnerable.
Let's just focus on one group, the self-employed. There are about 4.6 million of them in the UK. Many are freelancers, sole traders, or part of the gig economy. Their income is often unpredictable, and their work patterns just don't fit into the neat boxes of a system designed for traditional 9-to-5 employment. This makes them particularly vulnerable to an algorithm looking for anomalies.
And the reasons freelancers often get flagged are complex. It could be highly irregular income patterns that look suspicious to a machine. Or maybe they have lots of complex expense claims. Many freelancers mix their personal and business finances, which can create red flags. Or they might simply work in a sector, like construction or creative industries, that the algorithm has learned to treat as high risk.
So it all comes down to this fundamental conflict. On one side, you have the incredible potential of technology to create an efficient tax system. But on the other, you have the risk of building a cold, unforgiving system that lacks the vital element of human understanding.
This slide really sums it up. We have two sides to this coin. The promise is a fairer tax system, where technology helps ensure everyone pays their share. The peril is a system of automated suspicion, where honest freelancers can be unfairly targeted, leading to immense stress and financial hardship. Both of these realities are happening right now.
Which leaves us with the ultimate question. The drive for data-driven tax collection isn't going away. So the challenge is this: as HMRC gets smarter, how do we ensure the system stays fair and doesn't just create digital traps for the self-employed? Now, the information in this video is for general purposes only and should not be relied upon exclusively to make financial decisions. Navigating an HMRC inquiry can be incredibly complex. Before making any decision, you absolutely must consult a professional. The experts at My Tax Accountant are specialists in this area. You can reach them on 020-857-0531 or email them at info@mytaxaccountant.co.uk. Thanks for watching, and don't forget to subscribe to the channel for more insights.